Okay, so when we trade NASDAQ or ES, what we want to understand is the daily bias doesn't come from the higher time frames, right? The higher time frame bias actually comes from 15-minute levels. And so I'm going to be using this particular video just to break down my step-by-step process. So if we just go up to the 4-hour. Now, on the 4-hour, let's zoom all the way out, right? So this is NASDAQ on the 4-hour. So it doesn't take me long to form a higher time frame bias. In fact, it takes me less than 10 minutes per day. And this is how I do it. So I'm starting with structural highs, structural lows, structural highs, and structural lows. Now from here, this is what's important to understand. Every time you see a break, I want you to draw an arrow, right? So here's where we have one break, and then down here we had another break. And so the reason I'm highlighting this is that market structure on the higher time frames gives you massive clarity as you go down to the lower time frames. So on the 4-hour time frame, what we have here is our most recent high and our most recent low. And anything you see inside is internal, right? This is internal market structure. Now, this is important. So what we want to do is we want to project our fib tool from the structural high down to the structural low, just like this. Structural high down to structural low. Now, I've made previous videos about this, so I'm going to do this a little bit faster. So NASDAQ. The 4 simple steps that I follow: market structure, dealing range. Now premium and discount and fair value gaps go together. So what I'm looking for in the premium is a couple of different things, right? I'm mainly looking for basically fair value gaps. So on the 4-hour time frame, we have our 1 FVG over here. This is one fair value gap, right? So this is the fair value gap on the 4-hour time frame. And what I will do is I will take the candle before the fair value gap. This is now my key level. This is my point of interest, or my POI. So what I do is I just drag this zone over to the right. And so this is a POI for 2 simple reasons, right? We can see here price rejected heavily off this area. So why is this a POI for me, right? So there's 2 things that make a POI for me, right? The first thing comes down to basically there being a fair value gap. So there has to be a fair value gap in order for it to be a POI. Now the second thing is we're way above the 50%, so we are in a premium. So these are the 2 things that I use to validate all of my key levels. We have a fair value gap and we're in premium, right? So this NASDAQ level here is quite important. So I'm just going to drag this over to the right, and we can see the rejections to the downside of this area were pretty heavy, right? So this is our major 4-hour level. Now on the flip side, we do the same thing, but for the discount. So on the discount now, here's our discount array. Let's put that there. What we're looking for again, we're looking for a fair value gap in the discount. So in the discount, our fair value gap was just over here. It's a bit small this time, but this is our FVG. So I get lots of questions about this. So I just want to clarify this. This is the fair value gap in blue. Now, what makes this a fair value gap? Very simply is we have a gap here, and we have a gap between this wick and this wick. And so this is the fair value gap, all right? This is the actual zone. So now what I will do is I will take the candle before the fair value gap. So that's going to be this black candle here. Now, once you have this black candle here, right, what you're now looking to do is drag this box over to the right. And so what you can see here is, again, a clean or a pretty clean rejection of these areas. So when it comes to forming a higher time frame bias, this is how simple it is, right? Notice how it's come down to 4 simple steps. You're looking for market structure, so highs and lows. You want to know whether you're in premium or discount, and then you're simply rejecting or looking for those rejections of premium and discount fair value gaps. So that is how we approach the 4-hour time frame. Now, when we go to the 15-minute time frame, right, we have our 4-hour levels over here. We actually do the same thing. So from a 15-minute perspective, this is how I do it, right? So I use the same 4 pillars, right? The same 4 pillars, which I'm going to quickly go over. So we have market structure over here. That is the first thing, or that's the first sort of pillar. So market structure, again, we use the same sort of approach. We have our structural low, structural high. And then we have, for me, this is a structural low, structural high, structural low. And then on Friday, the AM session and PM session, we broke above that. So that's the first of the 4 pillars. We have broken market structure. These are our highs and lows. Now from here we have, of course, dealing ranges and PD arrays. But what's interesting here, right, is that we don't have any sufficient pullback. Now, what I mean by that is when we don't have a pullback, we don't want to force the dealing range. We don't want to force where we put our fibs. We don't want to force where we put our fair value gaps. And so how I would tackle this if I was trading this is I would just go back in time and I would look at market structure that was previously formed, right? So structure low, structure high, and then we had our break down here, right? There's our break. So now from here, we haven't got a clean pullback. But what's interesting now is we want to start looking at key levels, right? So we want to start looking at fair value gaps and we want to start understanding where our key levels are. So market structure, we haven't got a dealing range. We haven't got our PD arrays. But what we can do is go to step 4, which is identify 15-minute fair value gaps that have given us rejections, given us areas to trade from. Now, how do we do that? So one thing that I look for is previous day lows and previous day highs. So we're going to start off by looking at this low over here. So this was the low from Wednesday the 4th. So Wednesday the 4th, we had a 15-minute fair value gap just over here. So this is how the market works. The market will create these fair value gaps, or the market will create these key levels in and around previous day lows and previous day highs. So what's interesting about a previous day low is that this is where sellers were exhausted, right? This is seller exhaustion right here. So if we just take this zone over to the right, we can start to see how the market interacts pretty accurately with these zones, right? So this zone was created. This is now a 15-minute zone, right? So this is not on the 4-hour. So this is our 4-hour zone, and this is our 15-minute zone. So what we want to understand here is we've had a change in the market structure over here, internal change. We can use the order flow to confirm what's going on here. And then we have this previous supply zone flipping to demand. And so this is how I find my daily bias, right? My daily bias doesn't come from the 4-hour. My daily bias comes from using 4-hour levels and 15-minute levels to get together. So think about it this way. The core problem that I see traders face is that they don't have their direction down, or they struggle to find reversals or continuation. So this is how I would do it personally, right? So if I was looking at NASDAQ now, right, NASDAQ we can see is pretty close to the equilibrium, meaning this is premium, this is discount. We want to be buying in discount and we want to be selling in premium. When you're at the equilibrium, you typically don't want to be holding your trades for too long, right? That is the biggest thing I've seen with traders. Knowing where you are in the leg will set you up. So you don't want to be trading anywhere near this equilibrium line, right? That's one of the biggest problems you can fix when it comes to getting chopped out. So how would I approach NASDAQ in terms of daily bias? So what I can see here again is we have the structure that's gone from bearish now to bullish. So what we're looking for now is some kind of a correction to go higher. And so how do I find where those corrections are? So for me, I'm looking at 15-minute fair value gaps. So where did this fair value gap come from? Well, it came from a previous day low, Wednesday, the 4th of February. So this is where now the order flow comes in handy, right? So let's just take a look at the order flow. So this is NASDAQ 15-minute time frame, right? Same key level. We see the exhaustion of sellers down here, right? So this level on NQ NASDAQ was roughly 24. So this is the rough area of the level. So if we go to NASDAQ over here, we just mark this out. Here was our first sort of level, just here. So what we want to do as traders is we want to understand what was going on inside of these levels, right? We want to focus on supply and demand, right? Buyers and sellers inside of key levels. So let's break this down. Now, as we come into the zone, right, we're only interested in reading buyers and sellers. So what we can see here again, let's take a look at this rejection down here, right? So this rejection, without looking at the numbers, what we can see here again, a ton of aggressive buyers or blue delta coming into the market over here. So this is the 4-hour level being respected, right? So now what's interesting, right? What we can see, what we can begin to understand here is this. This is an area of supply, right? The market has respected this area as supply. Now, if we just take a look at supply, right? Let's understand why this was supply. So this was supply because of what was going on here. So this rejection over here was quite interesting, right? Fascinating rejection. What do we see inside the zone? So we see a blue delta here, we see blue delta here, and we see this blue delta here. So this red candle here is quite interesting. So when we kind of dive into what this candle was telling us, right? Let's take a look at this. This says 21 for 130. So this was a huge delta outlier, meaning there's positive delta. There are more aggressive buyers and sellers. So that is this region over here. So when we understand what was going on here, we see the following, right? We see 21 for 130. 21 for 130, right? What does this actually mean? Well, what this means is that there are more aggressive buyers. I'm just going to write AGG, more aggressive buyers than sellers. So despite there being more aggressive buyers, the market found resistance, or the market found an area to go down. So this is a true resistance in the market. So this was now Wednesday, holding resistance on Thursday. And what was interesting now is on Friday, we flipped the resistance. So this is now resistance to support, or for those who prefer, it is now supply to demand. That is what's going on over here. Now, this is quite important to understand, because when it comes to finding a higher time frame bias or a session bias, you are interested in what these 15-minute levels are doing. And so I have a 15-minute level resting just over here. So here is the 15-minute level, right? Or the 15-minute sort of area we're interested in, right? So on Friday, we tapped into that level and we had the opposite happen. So we had previous supply breaking to demand, right? That's exactly what was going on in this region. So let's try and understand what was going on here. So again, we can see lots of these aggressive buyers, aggressive buyers, aggressive buyers. But this time we break through the zone. So we want to kind of focus on what was going on in the retest, right? Or in this region here, only inside the key level. So if we just kind of dive into here, what we can see is green candle. Again, this is a bullish candle, the candle that breaks above the zone here. So this 5-minute candle represents this 5-minute candle over here, right? This candle that breaks. So we had a wick break, and then we had the final body break. But what was going on here, right? Here is where we saw more aggressive sellers than buyers, right? More aggressive sellers than aggressive buyers. And we had that over here. So when we look at the ATAS platform again, let's bring that up. When we look at the footprint charts again, what we're seeing is 117 for 6. So with footprint charts, you don't need to read every single number. You're only looking for the outliers. So once you have your key level or your fair value gap, you are only looking for specific outliers in that key level. This is what gives you an indication as to whether the market's going to go long or whether the market's going to go short. And so your ability to trade is going to come down to finding these levels and then trading the reactions off them. So here we have a green candle here, 2 massive red delta outliers, and we break above, right? So we saw 117 for 6 and then 124 for 27. So let's try and understand what was going on. So we see 117 for 6 and we see 124 for what was that number there? 27, right? 27. Now we see this data on the footprint charts over here. So we see this data. So what does this mean, right? And how does that differ to what we saw over here? So here there were more aggressive buyers than aggressive sellers, right? This is the art of key levels. There were more aggressive buyers and sellers, but the market moved down. So this here was an area of supply. So sellers were in control. Now the exact opposite is happening. So if we just take a look at what was going on here, let's break this down. Here we have more aggressive sellers. So I'm just going to write AS. Here, the aggressive sellers are more than the aggressive buyers. So what's going on? If we break above, it means that the sellers failed, right? These are failed sellers, which means that buyers are in control. So this was a supply zone, and now we've swapped to a demand zone. So this is very important when it comes to finding key levels or when it comes to forming your higher time frame bias, right? So your higher time frame bias will come down to understanding who is aggressive and who is passive at your levels. So let's quickly break this down. So another thing, going back to the 4-pillar approach, right? So the 4-pillar approach is quite interesting. We have a structural high, we have a structural low down here. So a couple of things to note about this is we have some liquidity resting over here, some equal highs, trend line liquidity, whatever you want to call it. we have a huge fair value gap on the 15-minute time frame. This entire region is an FVG. So if you trade like ICT concepts or whatever, what you'll do is you'll begin to understand that the market seeks liquidity and seeks fair value gaps. And so this is the overall bias going into the week ahead. Now, what's interesting now is we actually have this is our key level on NASDAQ. This is my main level on NASDAQ. So I want to see price come into this region and bounce higher. Or if we bounce lower and reject, then we're going to go bearish. So we're bullish if we can stay above this level, and we're bearish if we go below this level, right? So that's going to be bullish. That's going to be bearish. And so hopefully this video clears up how I find a higher time frame bias. Finding a higher time frame bias shouldn't be difficult. You've got to have your levels using market structure and order flow to kind of confirm what was going on. So don't neglect the data you see inside of the candles. This data here is very important when it comes to finding your key levels.